I'm Grant Walker. Welcome to Heads Up for Thursday, the 30th of April. John Stewart will have last call for you today from 4. To Christchurch. About 352 jobs are at stake in the winding down of the Canterbury Earthquake Recovery Authority in coming weeks and months. State Services Commissioner Ian Rennie has confirmed SERA Acting Chief Executive John Ombler will continue in the role until the end of 2015. He took over after former Chief Executive Roger Sutton left under a cloud at the end of 2014. A woman who complained about his behaviour remains on the payroll. In February, SERA moved from being a standalone public service department to become New Zealand's first departmental agency within the Department of the Prime Minister and Cabinet. A plan is currently being devised to transfer responsibilities and powers from SERA to local government or other agencies. This may provide a lifeline to some SERA staff employed on fixed-term contracts. A SERA spokesperson says staff are being updated on how work is progressing and what this work means for SERA. The transition plan is under the auspices of an advisory board of local stakeholders chaired by Dame Jenny Shipley. Following consultation on draft proposals in the coming months, a final plan is likely to be provided to the Cabinet by August. When the plan's finalised, SERA will start the process of moving functions to other agencies across central and local government. Mr Ombler was the establishment chief executive of SERA. He's a former Deputy State Services Commissioner and has also been a senior manager in the Department of Conservation. SERA was the brainchild of senior government officials and advisors after the 2011 earthquakes and was largely based on the experience of Melbourne, where a similar government agency was set up to redevelop the old port area of the city. But the challenges were quite different. The legacy of SERA is yet to be fully evaluated. On the positive side, the organisation oversaw the removal of damaged buildings that might have remained for longer. But it's proved less successful at managing the rebuild as private sector developers have raced ahead and completed many new office developments on land outside SERA's control. As a result, the shape of the city is nothing like the rebuild blueprint unveiled by Prime Minister John Key in 2012 amid much hoopla. The central city is shaped more like a dogleg along Victoria Street, Durham Street and Cambridge Terrace on the western bank of the Avon River, with the other part of the leg extending along Cashel Street. Cathedral Square has just a handful of operating buildings. According to many locals, the Crown via SERA acquired land it never needed, maintained acquisition designations over other blocks for too long and paid too much for properties. This means unless the Crown is prepared to take a loss, the cost of the central city land owned by SERA will be too expensive for developers for many years. Selling it cheaply might also affect values of developments currently underway. Business news. Carter Holt Harvey, strongly tipped for sale by IPO, has entered a conditional agreement to sell its Copine and Bestwood units to New Zealand Panels Group, in a move that the First Union says will lead to the closure of manufacturing plants in Wiri and Rangiora, with a loss of around 40 jobs. CHH is owned by New Zealand billionaire Graham Hart, who was widely reported earlier this month as preparing to sell a 70% stake in the business by IPO in coming months. NZ Panels is 39.27% owned by Australian private equity fund Crescent Capital and is a supplier of particle board products supplied by Japanese-owned Jukin Nisho. Crescent was behind the $224 million float of Metro Glass, a window products manufacturer, on the NZX in July last year, among a range of involvements in New Zealand industrial plays in recent years. A CHH spokesman would not comment on the buyer or terms of the sale, saying only that staff were going through a consultation process brought on by the transaction. Asked whether CHH or the new owner would be responsible for plant closure decisions, he said, "That's part of the arrangement we are consulting about." A statement from First Union General Secretary Robert Reid said only the CHH wood product site at Kupu would remain open, employing around 10 people, under the consultations now occurring until May 8. He said First Union has a good redundancy agreement with CHH, which will help reduce the impact of the job losses if they occur. We know that the Rank Group, or Hart's investment vehicle, is trying to divest itself of its CHH operations, but it seems counterintuitive that while housing demand remains high, 2 panel manufacturing sites are being closed.
In media news, Jurassic Park and E.T. producers Universal Studios have joined broadcasters in the Global Mode lawsuit. And fellow Hollywood heavyweight 20th Century Fox has also joined in the legal action. TVNZ, MediaWorks, Sky TV and Sparks Lightbox are suing several ISPs and tech company Bypass Network Services for copyright infringement. They take issue with the global mode technology that enables internet backdoor access to movies and TV shows, and have requested an expedited hearing on the matter. The case had its first formal court date on Wednesday, with lawyers from both sides appearing before Justice Sarah Katz in the High Court at Auckland. Lawyer Rick Shearer, who is representing Call Plus, Flip and Orcon, says that, as expected, the conference concerned timetabling issues. He could not say when the full hearing would be held. Mr. Shearer says Universal Studios and 20th Century Fox have joined the case as consenting parties. Universal Studios New Zealand legal counsel Matt Sumpter says he can't immediately comment on the studio's decision to join. The lawyer representing the media companies, Buddle Findley's Graham Hall, was not immediately available for comment. And that story from Victoria Young.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
I'm Grant Walker with Heads Up. Here's what's trending on NBR Online. The OCR statement is out, but at the same time, Fonterra slashes the Farmgate milk price. Carter Holt Harvey in selling mode, so what's been sold and how many job losses? The Auckland Council plays down the Taniwha tax. Obama has a stern warning over the TPP. Ombla will manage the Sarah wind down, and if you're travelling today, Auckland, a few showers, fine in Wellington, fine in Christchurch, and a few showers in Dunedin. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the brewing industry, Coca-Cola Amatil has opened its expanded brewery in Suva as part of an aggressive export push for its Fijian beer and rum brands. CC Amatil's Managing Director for Alcohol and Coffee, Shane Richardson, told The Australian that the company's loss-making beer division would break even this year. Earnings have fallen short of target since the company began brewing again after a 2-year break. It's reinvested in the industry, joining with its partner Casella Family Wines to launch Yenda Pale Ale as part of a push into the craft beer market. CC Amatil has also invested 11 million Australian on the Suva Brewery, operated by Paradise Beverages. The expansion has doubled its annual capacity to 5 million cases of beer. Mr. Richardson says there's a huge opportunity to export Vonu Pure Lager as well as Bounty Rum. He says, we believe Vonu has enormous potential. It's great beer from the Pacific, and we're doing more work on the positioning and look of the brand. We plan to take that to a wider market, with the key markets being Asia, Europe, the Americas, and Australia. If you look at other Fiji brands, they have had some very strong success, especially in the American market and with the European markets. Paradise Beverages is owned 89.6% by CC Amatil, which bought the stake from Saab Miller in 2012 after the Foster's takeover. Paradise will invest 28 million Australian over 3 years on the plant and equipment to redress years of underinvestment. Mr. Richardson says CC Amatil Managing Director Alison Watkins is fully committed to building the alcoholic beverages side of the business. He said, we're investing a lot of time and effort in ensuring the longer-term part of this business in alcohol has strong foundations. He says it will break even this year, and it's only our second year back in beer. You don't create an overnight success in beer. Beer you have to work at. The Jim Beam Dark Spirit business has also improved and is now in growth. He says Jim Beam's new owner, Japan's Suntory Holdings, supports CC Amatil's plans for the brand in the region. To the OCR statement. The Reserve Bank of New Zealand kept the official cash rate at 3.5% and said it may have to lower the rate should demand and inflationary pressures track lower than would be consistent with its inflation target. Governor Graham Wheeler changed his language compared to the March 12 monetary policy statement, dropping any reference to the possibility of rate hikes, repeating that the Kiwi dollar is unjustifiably and unsustainably high and painting a weaker picture of trading partner growth. Mr. Wheeler said the timing of future adjustments to the OCR will depend on how inflationary pressures evolve in both the non-traded and traded sectors. It would be appropriate to lower the OCR if demand weakens and wage and price-setting outcomes settle at levels lower than is consistent with the inflation target. A change of tone was anticipated after Assistant Governor John McDermott said last week that the bank isn't currently considering any increase in rates. Wheeler repeated those words today, saying the bank expects to keep monetary policy stimulatory. The New Zealand dollar dropped half a cent on the news to 78.43 US from 79.02 just prior to the release. So inflation is now close to zero, rising at an annual rate of just 0.1% in the first quarter, the smallest annual movement since the year to September 1999. The central bank's MPS forecasts of last month have annual inflation staying below the midpoint of its 1% to 3% target band through until at least March 2017. McDermott said last week that much of the weakness reflected falling fuel prices, and assuming crude oil doesn't extend its 50% slump since July 2014, would drop out of the inflation rate at the start of 2016. Today, Wheeler said underlying inflation remains low and is expected to pick up gradually. Mr. Wheeler said monetary policy will focus on the medium-term trend in inflation. The New Zealand economy continues to grow at an annual rate of about 3%, helped by low interest rates, high net immigration, construction activity and the decline in fuel prices, he said. House price inflation is elevated in Auckland. Weighing on growth, though, were lower dairy incomes, the lingering effects of drought, fiscal consolidation and the high kiwi, which on a TWI basis is above the average 76.7 level the bank had projected for the second quarter. Mr. Wheeler continued, "We're watching closely the ongoing impact on tradables inflation from global forces and the high dollar. On a trade-weighted basis, the New Zealand dollar continues to be unjustifiably high and unsustainable in terms of New Zealand's long-term economic fundamentals. The appreciation in the exchange rate, while our key export prices have been falling, is unwelcome." Traders may pick up on the use of the word unwelcome as they try to gauge the bank's willingness to intervene in currency markets, a tactic it rarely uses, but for which it has some billions of dollars available. Wheeler's take on trading partner growth is less upbeat than was the case in last month's statement, when he said growth this year was expected to be at a similar pace to 2014, while he said today that trading partner growth continues at around its long-term average. It remains dependent on highly accommodative monetary settings. He said looking ahead, considerable uncertainties exist in Europe, China and Australia, and on the timing of US monetary policy adjustment, although global growth should be boosted by the decline in world oil prices.
In energy industry news, an analyst says if Genesis stock falls any further, it will attract the eyes of bargain hunters. The power company surprised the market on Wednesday morning with its announcement it will not meet its full-year forecasts. The Auckland-based company now says earnings before interest, tax, depreciation, amortisation and other fair value changes will be between $330 million and $345 million for the year to June the 30th. Genesis's prospectus from March last year estimated it would make $363.4 million. Net income is now expected to be between $85 and $95 million, compared to the prospectus estimate of $95.4 million. Craig's Investment Partners analyst Mark Lister tells NBR Radio it's obviously disappointing to see a profit downgrade. It doesn't seem like the market was expecting it, because if it was, there wouldn't be such a strong share price reaction. He says while Genesis management warned at the half-year results in February the company was facing headwinds from weaker global oil prices and aggressive competition for customers, shareholders seemed not to have factored this in until they got confirmation this was a strong reality. Genesis stock price has dropped 7.41% to $2 since the announcement. Mr. Lister says there'll be a few bargain hunters taking notice if the share price falls too much. Under $2 would look attractive, so there's a bit of a floor in terms of weakness in here. New Zealand's largest energy retailer says it's downgraded its forecast due to losing electricity and gas customers as competition ramped up and wholesale electricity prices declined. In the 3 months to March the 31st, Genesis lost 0.3% of its electricity customers, reducing the total to just over 516,000. Its gas customers reduced 1.3% over the quarter to just under 106,800. Mr. Lister says this serves as a timely reminder that while the electricity sector is viewed as stable, low risk and predictable, it's not always the case. Contrary to what people think, there's a reasonable amount of volatility in earnings in the sector. And that story from Calida Smiley.
NBR. NBR Radio. With Crombie Lockwood. Insurance intelligence is business intelligence. Talk to Crombie Lockwood.
I'm Grant Walker. Welcome to Heads Up for Thursday, the 30th of April. John Stewart will have last call for you today from 4. To the dairy industry, following what is understood to have been an extraordinary meeting of the board yesterday, Fonterra has reduced its forecast farmgate milk price from $4.70 a kilogram per milk solid to $4.50 for this season. Combined with estimated dividend range of 20 to 30 cents, this amounts to a forecast cash payout of $4.70 to $4.80 for the current season. Under the Dairy Industry Restructuring Act 2001, the board had not been expected to review the payout until late May, so the announcement has taken most by surprise. In a statement, Fonterra Chairman John Wilson says the reduction reflected the continuing and significant volatility in international dairy commodity prices caused by oversupply in the market. He said, "We have confidence in the long-term fundamentals of international dairy demand. However, the market has not yet rebalanced and GDT prices for products that inform our farmgate milk price have fallen 23% since February. This reduction will impact cash flows for our farmers, who will need to continue exercising caution with on-farm budgets. Our farmers are already managing tight cash flows. Although this reduction is not the news that anyone wants, it's important we keep our farmers updated given the significant market uncertainty. Given the reduced milk price forecast, we're also lowering the advance rate of scheduled monthly payments to our farmers." Mr Wilson says we will continue to keep our farmers updated as the season progresses. Chief Executive Teo Spearing said geopolitical unrest in places such as Russia, the Middle East and North Africa is impacting global dairy demand. Mr Spearing says remote as they are, events such as the flow of refugees from Libya to Europe come together with factors like lower oil prices to soften dairy demand. In court news, TVNZ, MediaWorks, Sky TV and Sparks Lightbox have released a statement welcoming a court's decision for a quick hearing on the Global Mode case. The four companies are suing CallPlus, Flip and Orcon and tech company Bypass Network Services for copyright infringement. The case had its first court conference yesterday, with lawyers from both sides meeting before Justice Sarah Katz in the High Court at Auckland. In a statement, the media companies say they're confident about their legal position and welcome the urgent hearing for certainty's sake. The statement says the application for a quick hearing was opposed by the defendants. As NBR Radio reported earlier, movie studio 20th Century Fox has also joined the case. Barrister Graham Edgeler explains the media companies would have had to convince the judge it was in the interest of justice to have it heard early. However, no date has been set yet. The lawyer says yesterday's ruling does not guarantee the case will be held within days, weeks or months. Mr Edgeler says when the court feels it's appropriate for there to be an expedited hearing, they will try to accommodate it as soon as possible. But the longer the hearing is, the more difficult it will be, adding that the Global Plus case was unlikely to be a half-day affair. NBR Radio understands the expedited hearing strategy is being used because trying for an interim injunction would have been too hard for the media companies, given the length of time Global Mode has already been in the market. The lawyer for the ISPs, Rick Shearer, said he'd not yet received formal notification of the decision and could not yet comment.
In business news, LA-based private equity firm Oaktree Capital now has a 77.83% stake in MediaWorks, having bought out Westpac New Zealand and Royal Bank of Scotland. The two banks had partially funded private equity firm Ironbridge's 2007 purchase of the company and became shareholders when they converted their debt into equity following MediaWorks' 2013 receivership. Westpac New Zealand held just under 22% and Royal Bank of Scotland 14.6%. The bank's exit means MediaWorks now has just three shareholders, Oaktree, TPG with 15.69% and Bain Capital subsidiary Minnow Light APAC with 6.49%. NBR Radio has approached MediaWorks for comment on the change in ownership, but has yet to receive a response.
NBR Radio with Snap. Work, play and live connected with Snap.
Just what is Waitemata Port land worth? An activist group claims Auckland's Waitemata Port sits on the most expensive car park in the world. A press release issued on behalf of protest group Stop Stealing Our Harbour claims that if only half of the port's 61.6 hectares was converted to private use, the land would be worth about $2.2 billion based on land prices close to the waterfront. Ports of Auckland says about 1/3 of the port's operating area is used for cars regularly. The protest group's figures come from a submission to the Auckland Council's unitary plan prepared by economist Aaron Schiff for the Committee for Auckland. Dr. Schiff says at 5% growth a year, the opportunity cost of using the Auckland waterfront as a cargo port could be more than $3 billion in 10 years. The rating valuation of the port land, excluding the wharves, is $414 a square metre, which values the land at $76 million. Real estate agents say the most recent sales of waterfront land are at about $5,000 a square metre. Dr. Schiff says substantial and continuing investment in and maintenance of rail and road infrastructure to serve the port is estimated to cost anywhere between $100 million and $1 billion. The submission says Ports of Auckland's economic information to justify its place in the prosperity of Auckland is flawed. Dr. Schiff says the port's company numbers focus narrowly on economic impact analysis rather than the wider cost-benefit analysis of its operators. In other words, they don't take into account wider benefits or costs of their decisions. This omits a lot of the port's effects on Auckland and New Zealand. So in economic terms, Dr. Schiff says Auckland's incessant growth causes an increase in the opportunity cost of having a cargo port in the CBD, and he's urging the council to include a full cost-benefit analysis of the current and future costs of the port in the council's year-long Future Ports Survey. He said a cost-benefit analysis is the best way to assess alternative options for the port in the long term. The figures are being disputed by commentators who say Stop Stealing Our Harbour doesn't really know what it wants. On the one hand, the protest group is claiming it doesn't mind the port staying as long as it doesn't grow, but at the same time is measuring the port up for sale. A sale is highly unlikely, as Auckland Mayor Len Brown has repeatedly said the council's assets will not be for sale on his watch. The protest group's use of Dr. Schiff's figures raises questions about their veracity, as they give the impression that if only half the port was sold, it would be worth about $2.2 billion. The press release doesn't mention the other half of the port, but a closer read of Dr. Schiff's submission reveals he says the rest of the land would be public space. People. The former All Black halfback Mark Sharky Robinson, who recently denied he's bankrupt, put $70,000 into a failed lifestyle property development after former Health Pizza franchisee Matt Blomfield encouraged him to buy into it. NBR Radio has reported a Mark Darren Robinson, born in 1975, was in February bankrupted by the High Court at Wellington on an application by ANZ. The former All Black, who shares the same full name and year of birth, denies it's him. Only one Mark Darren Robinson is listed on New Zealand Companies Office records, which a lawyer confirms is the ex-All Black known as Sharky. But it now emerges the same Mark Robinson was also a director and shareholder of a now struck-off company called MDJ Properties. The company's other director was Matt Blomfield, who last year took defamation proceedings against whale oil blogger Cameron Slater. A 2011 High Court judgment shows both Mr. Robinson and the company were defendants in a dispute with Mangawhai Developments, which went into receivership in 2009, owing more than $9.1 million to secured creditor Matrix Custodian. Mr. Blomfield was also one of two sales agents engaged for 6 months to market the development. He was to be paid a $10,000 monthly retainer plus $5,000 for every sale, so long as he averaged 2 a month. Mangawhai Developments' 47-lot farm park-style subdivision was located at Devich Road in the popular lifestyle area of Mangawhai, just over 100k north of Auckland. Mr. Robinson entered 2 agreements personally and another 5 through the company, transferring $20,000 to a trust account in June 2005 and another $50,000 in August of the same year. Justice Peter Woodhouse says in his judgment, Mr. Robinson and Mr. Blomfield were at school together, and in 2005 Mr. Robinson was contacted by the latter about the development. He was in the UK at the time, having shifted there in 2004 to play rugby union for Northampton, but Mr. Blomfield encouraged him to buy into it. Mr. Robinson's undisputed evidence was that he invested in the development purely on the basis of what Mr. Blomfield told him. His evidence says Matt was dealing with these matters on my behalf. It was initially intended that Matt and I would be joint shareholders in the company. After the sale and purchase agreements had to be cancelled, the entire shareholding of the company was transferred to me. The various lots available as part of the development were priced between $155,000 and $300,000. For more on this, go to nbr.co.nz. Let's talk TPP. US President Barack Obama says if the US were to fail to enact the Trans-Pacific Partnership, or TPP, China would step into the resulting economic vacuum. Mr. Obama told American media if the US doesn't write the rules, China can be expected to fulfill that role. He says we will be shut out, American businesses and American agriculture. That will mean a loss of US jobs. Last week, Mr. Obama said he expects the US Congress to pass a crucial Trade Promotion Authority, TPA, known as Fast Track, to speed up the completion of the laggard deal. But the controversial TPP deal still seems to be an uphill battle, with members of his own Democrat Party continuing to show opposition. He warned of the rising anti-globalization attitudes in Washington from both major parties. Mr. Obama says this anti-global attitude from both the right and the left of the political aisle is a big mistake, and made it clear the US cannot withdraw from the TPP deal. Trade Minister Tim Grosser told NBR Radio the indecisiveness from the US Congress and the constant delays may trickle down to more problems in the Pacific. He says some countries involved in the TPP agreement simply refused to complete the deal until Congress has spoken and made its intentions clearer. Mr. Grosser refused to name which countries they are for diplomatic reasons. Mr. Grosser says ultimately we now need the US Congress to get TPA through. Will it get through? Well, Washington insiders to a person said yes, but the politics of this are very complicated. There are people in the Tea Party side of the Republican Party who don't want to cooperate on anything because of partisan politics, and there are Democrats on the other side of the House who are influenced by anti-trade rhetoric.
NBR Radio with GE Capital, championing mid-market businesses in New Zealand.
I'm Grant Walker. Welcome to Heads Up for Thursday, the 30th of April. John Stewart will have last call for you today from 4. In People News, former Transpower Chief Executive Patrick Strange has joined the board of the stock market operator NZX. The Wellington-based company said Strange, who headed up the national electricity grid operator for 6 years, will join the NZX board as an independent director effective tomorrow, with shareholders approving the appointment at the annual meeting later next month. He's also a director of Mighty River Power, Chorus, WorkSafe New Zealand, and of the joint board of Ausgrid, Endeavour Energy and Essential Energy Australia. The stock market operator has outsourced its indices to S&P Dow Jones Indices, the international market indices firm, to produce and commercialise new indices across equity markets and fixed income securities. It's also targeting New Zealand's growing fund management sector, acquiring fund manager Superlife last year for $20 million in cash and shares. Shares of NZX last traded at $1.17. To the courts, Alex Sweeney, the former boss of Auckland business organisation Heart of the City, could be off to prison today after admitting to more than $4 million in tax evasion and fraud. Last week, Sweeney pleaded guilty to a charge brought by the Serious Fraud Office of dishonesty using documents. He'd already admitted in January to charges laid by the IRD covering $1.8 million in unpaid taxes. The IRD also alleges Sweeney owes $1.4 million in penalties and interest. Sweeney was released on bail, but today will appear on the Auckland District Court for sentencing on the SFO charge and 4 IRD charges. The maximum prison term for the SFO charge is 7 years. A judge has previously indicated jail is a likely outcome. Sweeney created fictitious invoices while at Heart of the City that resulted in payments of more than $2.5 million to accounts controlled by him. SFO Director Julie Reid says the misappropriation increased the cost of the services provided by the organisation and reduced the benefits delivered by it. She said fraud of this size by employees who are entrusted with the management and expenditure of substantial sums of money is very costly for both the businesses concerned and more broadly for the community, as it harms the integrity of these organisations. Sweeney had initially denied the IRD charges last year, but changed his plea after switching lawyers to Murray Gibson. Sweeney also faces civil proceedings by Heart of the City's board, which undertook an independent investigation when the allegations surfaced. Heart of the City is mostly funded by targeted business rates, and its purpose is to promote business in the Auckland CBD. In its most recently available annual report from 2011-12, the organisation records receiving $4.47 million in revenue. Earlier this year, the association teamed up with Auckland Tourism Events and Economic Development, TEED, to fund a domestic tourism campaign. It had previously funded the Whitcoulls Santa each Christmas, but NBR rich listers the Mansons and Sky City are now funding the statue for 5 years. Mr. Sweeney had been at the helm of the business association for more than a decade. In 2007, he unsuccessfully ran for mayor of the then Auckland City Council, losing to John Banks. To the OCR, the Reserve Bank has made its strongest signal yet that a cut to the official cash rate is likely, abandoning both its previous line that a period of stability for the official cash rate is needed and that the next move could be up or down. Governor Graham Wheeler indicated a cut could be coming. As expected, the Reserve Bank kept the OCR at 3.5%, where it's been since last July, and which it still says is stimulatory. But annual inflation at 0.1% and expected to go lower, plus a stubbornly high exchange rate, are propelling the central bank toward an interest rate cut. Mr. Wheeler says in his latest OCR review, the bank expects to keep monetary policy stimulatory and is not currently considering any increase in interest rates. It would be appropriate to lower the OCR if demand weakens and wage and price setting outcomes settle at levels lower than is consistent with the inflation target. Unlike previous rate cuts, the move is not being driven by an economic slowdown. While lower dairy incomes, the lingering effect of drought, the government's fiscal consolidation program, and the high exchange rate are weighing on the outlook for growth, the Reserve Bank says annual GDP growth is still running at around 3%, and this is expected to continue. Offsetting those negative factors are low interest rates, high net immigration and construction activity, along with the fall in global fuel prices. And then there are those high Auckland house prices the Reserve Bank has been concerned about. The vexed issue only got a passing mention in today's statement. The Reserve Bank is not, though, going to cut interest rates at a time of 20% annual increase in house prices in the country's largest city. At least it's not going to do so unless it can be reasonably confident of not throwing petrol on that house price bonfire. That means the Reserve Bank's next big event, the biannual financial stability statement due in 13 days' time, is assuming ever larger significance. Restrictions on lending to property investors, most likely via some kind of larger capital requirement imposed on lending institutions, have been discussed over the past 18 months by RBNZ officials. Any such restrictions are most likely to be announced at the time of the Financial Stability Report. Such measures are concerned with the overall stability of the country's financial system rather than, as with OCR announcements, inflation.
NBR Radio with AUT. AUT Research, benefiting New Zealand. AUT.ac.nz/catalyst.
I'm Grant Walker with Heads Up. Here's what's trending on NBR Online. The OCR statement is out, but at the same time, Fonterra slashes the Farmgate milk price. Carter Holt Harvey in selling mode, so what's been sold and how many job losses? The Auckland Council plays down the taniwha tax. Obama has a stern warning over the TPP. Ombla will manage the Sarah wind down, and if you're travelling today, Auckland, a few showers, fine in Wellington, fine in Christchurch, and a few showers in Dunedin. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. Let's talk that property tax. Auckland Council says only 36 of 300 resource consents since March last year have required the controversial Cultural Impact Assessments, or CIA, outlined in the proposed Auckland Unitary Plan. The Council says some amendments agreed by the Development Committee on March the 24th will ensure the requirements only apply in situations where there is the potential for a resource consent to have an adverse impact on the cultural values of Auckland's mana whenua. The Council made the statement in response to the Ginger Group Taxpayers Union accusing the Council of unnecessarily imposing a taniwha tax that could cost more than $4,000. According to Chief Planning Officer Dr. Roger Blakely, this will be the Council's position going into mediation with Aucklanders who have made submissions on this aspect of the proposed plan. The Council remains open to discussing the views of submitters and exploring ways of reaching a common ground. His comments confirm some of the Taxpayers Union's concerns. When the CIA requirements came into effect in September 2013, concerns were raised about the difficulty applicants might have engaging directly with mana whenua to confirm whether or not a CIA is required, and if so, how one might be prepared. Dr. Blakely says to address these concerns, the Council set up a facilitation service in March last year, which has dealt with almost 300 applications in that time. Of those, 36 resulted in mana whenua confirming a report is required. This is from a total of more than 10,000 resource consent applications in roughly the same period. He says the Council intends to continue to require the reports. He said they are a critical tool that ensures the Council is in an informed position when it comes to assessing the impacts of development on cultural heritage and the values held by mana whenua, but ultimately decisions still rest with the Council. Mediation on submissions started this week, with the hearing scheduled in May. But the Taxpayers Union says Auckland Council needs to rein in its spin doctors and give an honest account of how much the cultural impact assessment requirements are costing Aucklanders. They say figures released by the council suggest 10% of all applicants are being required to fork out thousands for one or more cultural impact assessments. It could mean the Taniwha tax is even larger than we had estimated. The council spin doctors are trying to downplay the issue, but still refuse to tell us how many resource consent applications have been declined due to a lack of a cultural impact assessment. We say that's not good enough. In business news, Tourism Holdings, the largest campervan rental business in Australia and New Zealand, has boosted full-year guidance for a third time and hired First New Zealand Capital to review its capital structure. The Auckland-based company said it expects annual profit to be between 19.5 and 20 million in the year ending June 30 from the 11.1 million it recorded in 2014. Tourism Holdings has lifted its annual forecast twice before. In December, it expected at least 17 million, an upgrade for its earlier November range of between 15 and 16. The company has improved earnings across its businesses by selling off excess fleet capacity and focusing on margins. The company is looking to leverage earnings from New Zealand's booming tourism market to fund growth in the international motorhome market. It expects profit increases to be led by growth in its local and Australian rentals businesses, as well as cost-cutting. The near doubling of annual profit includes two one-off items, with a $1.6 million lift from the early termination of Alpine Bird after its 2012 merger with Kia, which is offset by a $1.5 million drop in the valuation of its Hamilton building, which it's in the process of selling. Tourism Holdings also reduced its debt forecast to between 65 and 70 million, down from guidance it gave at its first half earnings in February of a range between 80 and 85 million. The company has also hired First New Zealand Capital to review its capital structure as it looks for a way to maximise shareholder value. The shares last traded at 161 and have fallen 11% since the start of the year, having risen to a 7-year high of 190 in February. Tourism Holdings has announced an interim dividend of 5 cents per share, up from 2 cents a year earlier. In 2007, shareholders rejected a takeover bid by Australian company MFS Living and Leisure when the shares were at $2.80. While you were sleeping, figures confirming a sharp slowdown on the US economy at the start of the year sent stocks and the dollar tumbling. GDP grew a lower than expected 0.2% in the 3 months to March 31st. As businesses slashed investment, exports tumbled and consumers showed signs of caution. This was well below the 1% expansion forecast by economists and marks a significant downshift from the 2.2% pace of growth in the fourth quarter. Stocks on Wall Street held on to their losses after a statement from the Federal Reserve signalled that interest rate increases were still possible in the coming months, though the timing remained uncertain. The Fed statement, on the heels of a 2-day policy meeting, attributed the economy's first quarter slowdown to transitory factors, an indication that the central bank hasn't ruled out higher interest rates in the months ahead. The Dow Jones Industrial Average fell 0.4%. The S&P 500 was 0.4% lower as well. The Nasdaq fell 0.6%. European stocks plummeted, pressured by a sharp rally in the euro against the dollar on lower US growth. The Stoxx Europe 600 declined 2.2%, adding to the previous session's drop of 1.5% on weak corporate earnings. Germany's DAX lost 3.2%, France's CAC lost 2.6%, and London's FTSE fell 1.2%. In Asian markets, stocks fell in China and Australia. Oil prices, however, hit fresh 2015 highs after data showed a deceleration in the growth of US crude stockpiles.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.